Our next guest says it is precisely when markets are volatile that his strategy of buying dividend-paying stocks works best for investors. Jim Boothe is portfolio manager of the Nuveen Santa Barbara Dividend Growth Fund. It's a Morningstar 5-star fund, offered double-digit returns over the past year and has outperformed most of its peers over the last 5 years. And Jim joins us here in the studio to talk more about his strategy. Welcome to Fast Forward, Jim. Great to have you here. Let's talk about the strategy and that the introduction I made here about now being a good time to buy. I also was reading that you were saying, 2 years after a low, after we hit a bottom, is a great time to be an owner of dividend-paying stocks. Why is that?
There's a study that Ned Davis did, a research firm in Florida, and they looked back since 1973 and all through the other previous bear markets. And typically 3 to 5 years after a market bottom, and our last one was March of 2009, dividend stocks typically do almost 2 times as well as stocks that don't pay dividends. And we have this similar pattern since 2009 that's occurring right now.
And what is your criteria? Is it a 3% dividend payout?
The portfolio currently yields approximately 3.2%. But I think what we do different than other strategies, we just don't buy the highest yielding stocks. We barbell the portfolio. So we have some low yielding stocks that have very robust dividend growth rates, probably more found in a growth portfolio. And we offset that with some high yielding stocks. But these high yielding stocks do have dividend growth.
What are you finding in the many years that you've been overseeing this portfolio? What's different about right now than you've seen in the past?
What's different now is, I think, the market volatility. Every day, market's up, then the next day it's down. I personally think that's what we're going to have for the next 3-4 months. Anytime you see markets up 1%, people kind of get enthusiastic, and the next day it's down. I think it's something that we're going to have to live with probably the next 5-10 years.
And let's talk a little bit about today's announcement. You do own energy companies, oil and gas companies. I'm just looking at the S&P right now. The oil and gas sector down about close to 2.5% based on this news coming out of the International Energy Agency. How does that affect your portfolio? Those tend to be dividend-paying stocks.
I'm slightly underweight energy stocks, but generally it's positive for the economy as a whole because it's the gas prices, gasoline prices really affect the consumer's pocketbook. And it'll be a lag effect. Today's decline in oil prices, how it'll affect people's purchasing power. But the overall economy will benefit from lower energy prices. The last 5 years has basically been a bull market on commodities, not just oil and natural resources stocks. But for the stock market, the economy as a whole, to do well, energy stocks or energy prices generally have to be low.
Now we took a look at some of the stocks, your top stock picks, and correct my pronunciation here, Oniok or Oniok?
One Oak.
One Oak, okay. It's not that tricky. Seadrill as well. These are both energy-related companies, but year to date, they've both had double-digit returns. We have the one-year total return on One Oak at 64%, Seadrill up 81%. Are these the type of companies then that you pare back with returns like these?
Seadrill I trimmed last year because it moved up quite quickly. One Oak I haven't trimmed yet. But both those stocks have a general theme in the portfolio, and this is very robust dividend growth. When we added One Oak last year, the company came out and made a statement that they were going to raise the dividend 50 to 60% over the coming 3 years. And I've never seen a company make this announcement in all the years I've been in the business. And that got me excited about it. So that's an overriding theme in a lot of our companies in the portfolio.
And then quickly, financials. We have about 20 seconds here. Are you worried about, you have a weighting of about 12%, it looks like 13% in financials. Are you worried about that?
Yes. I mean, in 2007, we had 30% in financial stocks. We were fortunate enough to get out of a lot of the big banks before they cut the dividends and the stocks fell down. We're underweight now. We have some regional banks, though, that are quite strong, and we're comfortable with those.
All right, Jim, we have to end it there. Thanks so much for joining us today.